Divergence is one of the most powerful concepts in technical analysis. Divergence exactly shows the edges of a trend. This concept guides you to buy near the bottom edge or sell near the top edge. This concept reduces the risk you have to take, at the same time increase your profits. Once you identify the market's edge, your trades will no longer go against the market. This is how professional traders find the perfect entries at the market edge, because you can place your stop loss above the market edge, and there is a low chance that the price will break the market edge. But 99% of traders are struggling to spot divergences in momentum indicators. Some traders believe that trading divergences don't exist in real-time trading, because most momentum indicators are line charts, and traders are unfamiliar with it. Also, line charts do not provide much information about momentum indicators. This problem is solved by converting the momentum line chart to a Japanese candlestick chart. Now you can easily spot divergence and draw it like a professional trader. In this video, I'll show you how to use trading divergence correctly in your day-to-day trading. Before we begin, do us a favor, like this video, also subscribe to our channel, and click the notification bell to get new video updates. When price is moving upward, price creates higher highs and higher lows. Price reaches a peak level, and then price drops to a certain level. Peak point is high, and retrace point is higher low. We call it higher low because it is higher than the previous low, but the overall direction is upward. If the price breaks through the previous high again and creates a new peak point, it is a higher high. Again, higher low, higher high, and higher low. This is what we call an uptrend. If you notice price is moving in a straight line, change the chart to a lower time frames to see higher highs and lower lows. This uptrend will continue until the price becomes overbought. How do we know when the price is overbought or not? Momentum oscillators such as RSI, MACD, stochastic, CCI are using to identify overbought and oversold conditions. If the price is making higher highs, the oscillator should also be making higher highs. If the price is making higher lows, the oscillator should do so as well. But when the uptrend reaches the peak point or becomes overbought, the oscillator fails to make a new higher high. Instead, it draws a lower high. That means the price and the oscillator are breaking the connection and diverging from each other, and that's why it's called divergence. And this type of divergence is called as regular bearish divergences. Instead of creating a new higher high, the price is continuing to fall and creating a new lower low. Price tests the previous higher high or higher low before forming a new lower low. Retracement point is lower high. When the price is oversold, the oscillator fails to make a new lower low. The price and the oscillator are diverging from each other, and this type of divergence is called as regular bullish divergences. Regular bullish divergence clearly shows the downtrend has ended and a new uptrend will start. The oscillator signals to us the momentum is starting to move upward. Even though the price has made a lower low, market is more likely to go up than to keep going down. Regular bullish or bearish divergences are used to detect market reversal points. This is the market edge I mentioned at the beginning of the video. There's high probability the market will reverse after the regular divergence shows up in the momentum indicator. Please keep in mind, we use divergence as an indicator, not as a signal to enter a trade. We should combine divergence with additional confirmation tools to have a high probability of winning with relatively low risk. Let's discuss later in the video. Now I'm going to show you how to add these candlestick-based momentum indicators. If you want an RSI indicator, search RSI candle and add this indicator right here. I personally like RSI candle indicator. I normally hide zones and candlestick wicks. For MACD, search MACD candle and add this indicator. For stochastic, search stochastic candle and use this indicator. If you use MetaTrader 4, you can get these indicators from my Telegram channel, link in the description. Divergences not only signal a potential trend reversal, there is another type of divergence. We just learned regular bullish divergences is the price makes lower low at the same time the oscillator makes higher low. I switch these conditions, now the price makes higher low at the same time the oscillator create a lower low. Usually you can spot this kind of divergences during an uptrend. So this is a hidden bullish divergence. Hidden divergences tell us the price continues to move in its current direction. We connected peak points when drawing regular divergences, highest points in an uptrend and lowest points in a downtrend. But we connect retracement points when drawing hidden divergences. When the momentum oscillator is showing a hidden bullish divergence, overall trend direction is upward. This divergence perfectly lined up with the uptrend's retracement points. This indicates that the uptrend is still strong and the temporary pullback is ending soon. Price has returned to its current upward trend. Hidden bearish divergences are opposite to regular bearish divergences. Price is in a downtrend, so it makes a lower high, but the oscillator makes a higher high. We know regular bearish divergence is when the price makes a higher high and the oscillator makes a lower high, which is completely opposite. Hidden bearish divergence is showing us temporarily the price is going upward, but sellers are still active in the market. That's why oscillator creates lower high. Hidden divergences are very important to a trend trader because they take place during a pullback. Pullbacks offer a good second opportunity to enter a trade again if you miss the entry in a trend. Divergences tell us that the current trend will either change or keep going in the same direction. But divergences do not signal to buy or sell. As I said before, divergence is used as a setup condition and combined with additional confirmation tools. Your trades will have a high probability of winning with relatively low risk. So how do we take advantage of those divergences? Before we start, like this video if you're learning something important for your trading career. And don't forget to subscribe and turn on notifications. Trend lines are the easiest and simplest way to use trading divergences. Let's see how we trade regular bullish divergence with a trend line. I draw a trend line connecting these two lower highs. Price created a lower low, but the RSI indicator created a higher low. So this is a regular bullish divergence. But we drew a trend line and the price did not cross it, so we don't enter a buy trade. Again, price created a new lower low and the RSI indicator created a higher low. Also, this is very important, the price broke through the trend line and with a huge momentum. You can put a buy trade here. This is how we use regular divergence in trading. Now, if you look closely at this chart, you can see two hidden bearish divergences in this downtrend. Did you see it? The first is right here. The price made a lower low and the RSI indicator made a higher high. It means that the price will keep falling. If you missed the first entry, you have another opportunity to enter a sell trade right here. Again, price made a lower low and the RSI made a higher high. Also, the downtrend has created two resistance points previously. Price perfectly rejected near the trend line, and you can put a sell trade right here. In the next video, I'll show you a great way to use this RSI indicator based on candlesticks chart with this awesome indicator, so make sure you have subscribed and turned on notification bell. You can help me by liking this video and sharing it with your friends. See you, take care.